You know what's wild? Most people don't lose money before they save it, they lose it right after. Most people think hitting $20,000 means they're finally good with money, but that moment is actually the most dangerous point in your financial life. Quick question. Have you ever reached a savings milestone and then somehow slid backward a few months later? Yeah, that's not bad luck. That's psychology. Saving money feels like winning. Your brain celebrates, your ego wakes up, and suddenly a quiet voice shows up saying, "You earned this." Here's the uncomfortable truth: saving $20,000 isn't impressive, not losing it is. Because the second you hit that number, your mindset shifts. You stop thinking in decades and start thinking in upgrades: nicer apartment, better car, one well deserved vacation. Funny how nobody celebrates compound interest with champagne, right? This is the fork in the road. One path turns $20,000 into real wealth, the other turns it into a nicer lifestyle and zero net worth. Let's break down the mistakes that send people down the wrong path. First mistake: investing while high interest debt still exists. Someone has $20,000 saved, but also $8,000 or $10,000 on a credit card charging 20% interest. They tell themselves, "I'll invest and pay the debt slowly." That's not investing. That's lighting money on fire politely. You're paying a guaranteed 20% loss to maybe earn 8 to 10%. That's not optimism. That's bad math. If this were a business decision, your CFO would quit. Rule is simple: anything above about 7% interest gets eliminated before investing starts. No exceptions, no stories. Okay, debt is gone. Now people rush to invest everything. Big mistake. Life doesn't care about your portfolio. No emergency fund means you sell investments at the worst time, or swipe a credit card, or panic and make dumb decisions. None of those build wealth. An emergency fund isn't there to make you rich. It exists to stop you from becoming poor again. Peace of mind doesn't show up on your net worth tracker, but it keeps it alive. 3 months of expenses if life is simple. 6 months if life is complicated. Boring? Yes. Effective? Extremely. Here's the sneakiest one. You save $20,000. You feel successful, so you reward yourself. $350 a month doesn't feel dangerous until you stretch it over 30 years. That small upgrade could have been hundreds of thousands invested. Instead, it became a depreciating asset you stopped caring about in 18 months. Pattern interrupt. You didn't treat yourself. You taxed your future self. Lifestyle inflation doesn't feel like failure. It feels like progress until you zoom out. Here's the playbook that actually compounds. Step 1: kill all high interest debt, guaranteed return. Step 2: build an emergency fund in a high yield savings account. This is financial shock absorption. Step 3: max a Roth IRA as early as possible. Tax free growth is a cheat code most people ignore. Inside it, no stock picking, no Reddit tips, just broad, low cost index funds. Your job isn't to be clever. Your job is to not sabotage yourself. Step 4: automate investing, monthly. Boring, relentless. Pattern interrupt. The market rewards consistency, not confidence. Let's simplify. High interest debt? Kill it. No emergency fund? Build it. Long term money, tax advantaged first. Investments? Broad index funds? Strategy? Automate and stop touching it. That's it. No secret strategies. No dopamine trades. Just math, patience, and self control. That $20,000 you saved? It's not money, it's a test. Can you resist upgrading your life long enough to upgrade your future? If this helped, hit like and subscribe. It tells the algorithm you want more real finance, not hype. What would you be most tempted to spend that $20,000 on? Honestly,